Welcome, everyone. I hope you're having a wonderful week. So, for most of the early episodes of the show, we've been focusing on lessons learned. How to fundraise, how to write an MVP, or how to build an MVP, how to write a deck, etc. And now we're moving on to talking to like successful entrepreneurs who are now unicorn founders who've made it. And this week we're very privileged because we're going to be visited by two of my favorite founders, and frankly, one of my favorite, if not one of the favorite startup in the portfolio, which is Clearbanc, who now renamed Clearco, and they will be telling their story and why it's so amazing, and obviously talking about all the challenges along the way and lessons learned, etc. So, without any further ado, let's get this show on the road. So, welcome to episode 25, Clearco, and the future of finance. So, Michele, Andrew, thank you for joining me.
Great to be
Thanks for having
here.
us.
So maybe we could start with the basics, and you can introduce yourselves. Give the background and how it leads probably into this idea and why you build Clearco.
Sure, yeah, we can give our own personal stories led to a lot of the founding of this. My background, I'm a immigrant. Grew up in Toronto via Chicago, born in India, but studied engineering and then found my way to Silicon Valley early in my career through a fellow Canadian immigrant, guy named Chamath, who was head of growth at Facebook at the time, and he sort of convinced me to move out to San Francisco and join a company he was on the board of called Top Prospect. And for me, and I'd say, and this was in 2010, this was just as venture capital was starting to kind of come back into the ecosystem. And what I noticed was just how different the opportunities were for founders that I met in Silicon Valley, who would go to the same parties as VCs and hung out in the same circles, went to the same schools, compared to my friends back in Canada or in Europe or India or Asia that were trying to start companies. They weren't, the Silicon Valley founders weren't necessarily any more talented or ambitious or hardworking. They just had access to more capital and more opportunity, and with that came better profile and easier access to talent and customers. And so, big underlying theme through my career had been, how do we level the playing field for founders globally who may not have all those advantages? And so as I moved back to Canada, that was a big part of what I was doing. And I built a couple of tech companies in doing that. And I ended up helping to connect a lot of Canadian founders to Silicon Valley VCs. And actually, that's how I ended up meeting Michele. She was one of the prominent Canadian founders that was looking to raise money. And I connected her with some investors, back in the Valley.
Yeah, I mean, one of the things that makes Andrew and my story just so unique is that he had raised a lot of venture capital before this. I had raised no venture capital, so that is a true story. I asked Andrew to help me. I had built a couple of different businesses. I was crazy enough to build a fishery from scratch right out of engineering school. I built an e-commerce company that's now public in Canada. And I was building this early AI app. And I was like, Andrew, I have no idea how to fundraise. So he gave me my original tips. The company ended up selling to Groupon. And I was able and asked to join the cast of the Canadian version of the Shark Tank television series. So it's called Dragon's Den in Canada. And what was fascinating about the show is that, we see 250 pitches in 17 days. And it was the first time in my career I was moving from being like a full-time founder and operator into an investing role. And because, especially on TV, what you don't want to see B2B SaaS companies, you want to see product companies. We're seeing a lot of e-commerce companies. And I'm like, wait a second, all these founders are coming on the show and they're like, look, I'm willing to give up 10% of my company at the seed round for $100,000. And you'd ask them what they needed the money for, Fabrice. And it was always for the same two things. It was like, I need money for customer acquisition, which is Facebook and Google ads, and money for inventory. And so I get home and I'm like, Andrew, let's think about this. Why are founders using the most expensive capital in the world to do something with like a fixed return, right? You buy inventory, you can only mark it up by 3 times. You buy a Facebook ad, 30 cents is going to get you $1. And so, we dreamed up another idea of funding these companies. We said, look, we would give you that same $100,000 you were looking for, and instead of taking 10% would own forever. We just wanted 10% of your revenue until you paid us back our capital plus 6%. So first thing the founder said was like, oh my God, is this debt? And you're like, no, there's no personal guarantee. There's no fixed payment timeline. There's no compounding interest. And there's, most importantly, no debt on your business. If you don't pay us back, we don't bankrupt you. And so that was the first deal that was done on the show as the Andrew and Michele brainchild. And it's pretty crazy to think that, like, you know, we're a unicorn now. We've put more than $2 billion into 5,000 different companies. We're the largest e-commerce investor in the world. That all started off on this idea that we heard a lot of no's to in the early days.
What's interesting is after Andrew's intro, where it's like, okay, we want to level the playing field, I buy it, but wouldn't it make sense to level the playing field from Silicon Valley as opposed to like from Toronto? Doesn't that make it harder for you guys, or do you think it's actually easier because you're like, okay, we get your problem, we can fix it?
Yeah, we actually started. We went through the Y Combinator Fellowship. We may be. We haven't checked this, but we may be the most successful YC company that YC doesn't own any equity in, because we went through the fellowship. They had just launched the fellowship. They didn't know how to take equity in their companies. It was right when we started the business, and then we got rejected for the main YC program post fellowship. And so, I still have the email from Paul Buchheit on our whether we can actually, whether this business will scale. But we started in Silicon Valley, and I think what we realized was that it is a little bit of an echo chamber, right? And the problems that Silicon Valley founders face are not necessarily the problems that founders around the world face. And this types of capital that you need to unlock those, and the types of investors that you need to unlock those, might be quite different. And so we also found, from a talent perspective, we were hiring Canadians and moving them down to San Francisco, which didn't make any sense. And so that's why we ended up moving the headquarters back to Toronto. But now we're a global company. We're hiring people. We have teams in Ireland and Australia, throughout Europe, throughout the US.
How many employees do you have these days? Just get a sense of scale.
330.
Cool.
Yeah, so about 300, a little bit.
Let me summarize what I think the value proposition is, and you can correct me if I'm wrong, because I think it comes intuitively to us, but like the viewers of the show who may have heard of Clearco for the first time today, it may not be the case. So your prototypical small merchant, let's say with a Shopify store online, and to grow, you need to spend money on marketing and Google and Facebook, and you need inventory. And the reality is, these are not companies that should be VC backed. They're not good. 99% of them are not going to go from 0 to 100 million in revenues or a billion in revenues. So they need an alternative source of financing. And the issue is the Citibanks of the world and do not actually know and or not very good at lending to these people. And the reality is, they also don't necessarily would rather not have debt formally, because they would rather not be in a position to go under. And so you found an alternative means of financing where you pay yourself, you lend them the money. I mean, you log into their Shopify, you log into their Facebook and Google, you look at the profitability of their advertising, and if it's profitable, we're like, okay, we'll provide you capital, we'll reimburse ourselves by taking a chunk of the revenues that are flowing through the platform until we're reimbursed, and we get a 6% fee. And so it's not quite that, but it kind of, I mean, it sounds a little bit like that, even though it doesn't have the specific debt like criteria. Is that exactly how it works, or is it a little bit different from that?
Yeah.
Okay.
I'm going to jump in. Yeah, so exactly. I think that's exactly right. I think the way that I've always framed this for founders is, as you think about capitalizing your business, you want to sort of think about what your uses of proceeds are. So if you're investing in R&D, if you're creating something new, if there's a lot of if you're Michele was like, if you're inventing a new form of AI, you're putting a rocket on Mars, you're curing a disease, you're doing something that takes heavy R&D, new product development. Then equity and venture capital is a great source, right? If you're investing in pretty repeatable, scalable, parts of your business like marketing and inventory, then you can probably use something that doesn't have, the cost of equity and giving up ownership and control of your business. And then if you're investing in assets, right? If you're buying a piece of equipment or a piece of land or something, then debt makes sense, because, you can always sell that asset to pay off the debt. And so what we've tried to do is sort of say, on the spectrum of equity and debt, equity is offloading risk at a very high cost, right? You're selling shares of your company, you're bringing in a partner, you can't really get rid of that. Debt is, you're adding risk, you're adding leverage to your business. You're saying, look, I have something that's a tangible asset. I'm going to increase the risk in my business for lower cost capital. One of the challenges for a lot of SMBs is they don't have a lot of assets. And so if you raise debt, they will typically ask for a personal guarantee, which means they go after the personal assets of the founder and the business owner, which is, a pretty tough place if they take your home if your business fails. And so what we try to do is create something that sort of sat in between. So it's not going to be, a bank debt like a mortgage, but it's because we're not going to take your home if your business fails. And it's not going to be equity because we're not going to, we don't get 100x on our money. And so we've sort of created an instrument that funds repeatable growth, that sits between equity and debt.
It's interesting because you could have just made it debt non-recourse, and that would have any reason you didn't do that? Because there is clearly a mega trend towards debt is coming to venture. I mean, that's another Canadian, Alex Danko, who's been writing all these analysis saying, hey, if you have an MRR business, a monthly recurring revenue SaaS business, for instance, where you can predict the future and actually you can borrow it, you can grow it through debt. You don't need equity. And so why choose this hybrid model versus a non-recourse loan?
Yeah, I think and look, we were happy to be at the beginning of that like pioneering movement. I think when we started talking about debt, it was very unsexy, period. I think, look, we're getting into like the very technical elements of what we did something, but I go back to like who our founder was. And our founder was me. I had built an e-commerce business. I had figured out if we injected $1 into marketing, we could make $3 in sales tomorrow. Venture capital was extremely time consuming. Even if you are the best fundraiser, this is a 3 to 6 month process and you need a bidding war to get the valuation you want. And so our product in turn is connect the apps that run your business, and in 20 minutes, we can give you a term sheet. In 20 minutes, we can tell you how much capital we can give you, and that's up to $10 million. So that's really, impressive scale for what we can do. And then the second thing is you are not taking risk on that. I mean, your downside is that you pay us back our capital plus 6%. There is no downside where you use your company. There is no downside where you have covenants and warrants and MAC clauses. And I mean, a debt agreement is 40 pages for a reason. And so at the end of the day, we are like, could we use data to better make these decisions? And could we take more risk on these decisions because we understand your business better? Because it's very difficult to understand digital businesses. And that's why banks basically said, look, well, if we could take your assets or your personal assets, your assets, we don't have to understand these businesses. And so our secret sauce was really understanding digital businesses, whether that was e-commerce businesses or SaaS businesses, and understanding the quality of their revenue and the costs associated with that. And then building something for founders that was way faster, way more seamless, and just became a no-brainer for them.
Makes a lot of sense. So by the way, part of the reason I think Clearco makes so much sense is, obviously we're believers in the future of commerce being online largely, and online and e-commerce is gaining a larger and larger share of commerce. But as a VC, I don't want to be backing D2C companies because that's just giving money to Google and Facebook. I'd rather actually back the companies that are enabling the ecosystem, the Shopifys of the world, but in this case, the Clearcos of the world that grow with them. And then some of those are going to be successful, but we don't take the risk that the D2C specifically doesn't hit product market fit because you actually have all the data and you can make the bet in a much smarter and interesting way. So to me, Clearco is like a super smart way of like betting on the future of e-commerce, because actually it's not going to be just Amazon, right? Like if you look at market share, the Shopifys and the long tail stores are actually gaining increasing share. And so very, very bullish and optimistic on that.
Yeah, I mean that's our view is like this is 100% the future. This is where commerce is going, and every business has to be e-commerce and omni-channel. And we want to use the data that we've got to see what works and actually help these companies, beyond just giving them capital, helping them understand what to do how to grow their business even further and faster and more efficiently, right? Should they be spending on Amazon, or should they be spending on Facebook, Google, Pinterest, Snap? Like what's the right media mix for a company over a certain stage? We can actually start to give much more advice on how to deploy that capital efficiently as well.
So a little bit of like history. So you had this idea while in the Shark Tank of Canada, and you decided, okay, this is an opportunity. Let's pull the trigger. When was that exactly?
Andrew and I started Clearbanc, Clearco now, still getting used to our new name, at the end of 2015, and then we've been we went through a couple of pivots, and this product has really been in market for the last 3 years now. So it was, and I think that just like picking up on what Andrew said, like we think of the future of e-commerce and we think about how do we use now this data advantage we've gained to give that back to founders, right? Like they're the ones that are every day like, how do I build my business? And so we can show them how, they're benchmarking to 10,000 other companies that are in, selling footwear also online. We can, give them what their OKRs at this stage of their business should be. Like now it's time to diversify into another country or switch up your supplier, and understand their valuation. I mean, those were all different products that we launched last year that make it a competitive advantage for founders to not only just use us for capital, but all of the network and advice we can
actually this giving away a free B2B SaaS tool to especially SMB owners in order for them to run their businesses better is like something we're seeing over and over again in this day and age. In the case of like Slice, for instance, they're picking up the phone for the SMB owners. They're helping them like do purchasing of their materials, etc. They're like, look, what is it you want to be doing at the end of the day? In the case of the Luigis of the world, it's like cooking the pizza, talking to clients. What is it those e-commerce owners want to be doing? They want to be curation and like thinking through what is the product they should be selling and all the admin stuff. Like they didn't sign up for this in order to become experts at everything else. And so if you can help them in an intelligent way, they're gonna love it and they're gonna connect every day to do this.
And think about the downstream effects of that. Like I've never heard a founder say exactly what you're saying. I've never heard a founder say, I can't wait to be a founder so I can fundraise, so I can choose a credit card, so I can do my financial statements.
Yeah.
Like no one has ever said that. They said, I want to build an incredible product for my customers and market that product. And so if all of us in this community of startups can make every single one of those things a lot easier, think about how far these companies can go. And we've had this framing, and you used it earlier, a venture back is only like, can they get to 100 million? Can they grow by 10x? And I actually think when you free up people's times, we might see very different trajectories on these businesses that we've seen before.
Yeah, actually, this was my thesis of the future of work. In the future of work, people should only be doing the job they love to do, and everything else should be outsourced. And to your point, like if you're an SMB business owner, do you really want to be doing financial planning and accounting and et cetera? No. Like this is the admin part you hate that you don't want to be doing. So to the extent we can free them up to be creative, yeah, we could probably build much larger, more businesses and like empower people to have more interesting lives.
That's like a big part of the mission, right? Is can we get people to have more enjoyable, more interesting lives? Can we help communities and families access opportunity that was otherwise unavailable to them? And can we take all of the all of the administrative stuff, all the other sort of bullshit off of their plate to be able to just focus on what they do and create new products, create the world that they want to live in.
So this went to market in 2017, 2018. So walk us through the trajectory. Like how did it go from what it was then, the first few instances of providing money to startups to becoming a worth $2 billion at the last round? I mean, in 4 years, that seems extraordinary.
Go ahead, Michele.
Go for it. I was going to say, go for it.
Go ahead.
Oh my goodness. I think the most important message to founders is that even when it looks like outcomes are successful, it didn't feel like Andrew and I were fighting every day. Like there was no day where we were like, we've made it and this is working. I think there was like incredible moments. And I can share a couple of those, but this was just a relentless amount of grind. I mean, really, people thought that we were absolutely crazy. They said, you're giving small businesses with almost no history money without any ability to collect their personal or their business assets. And, we kept saying, well, we think the data is going to be more indicative. And that meant we heard a lot of no's. And just, look, early cohorts, we lost a lot of money on. So we had to figure out, first of all, how to get good at the craft that we were saying was a thesis. The second thing is we had to get good at finding these companies and where they were, and then figuring out how to help and grow with them. And I think then there's just been these moments that I think neither Andrew or I thought were possible. I mean, one of the things that we saw, I think this was 2 years ago, is, it was us and another company in credit cards that came up with the first, major products that didn't have personal guarantees for founders. And then that fall, Amex launched their card that didn't have a personal guarantee for founders. We're like, oh my gosh, like our little idea had enough impact for a Fortune 50 company. And that makes it better for every founder, which is like at the end of the day, our net goal. This year, I think that now less people are calling us crazy and more people are copying us. And so we've seen the Clearco of Latin America and the Clearco of all sorts of different jurisdictions around the world. And, make no mistake, we want to be the Clearco of those markets, but it's incredibly flattering when you get these moments where people are, taking the model that you've built and trying to apply it. And I think that net, this is a win. But I can tell you along the way, I mean, I felt like I don't know about you, Andrew, but I felt like every day was a fight. And it was like every day we're figuring out how to fix things in real time.
Yeah, I mean, it still feels like that, right? I think sometimes you get founders on podcasts and like, oh yeah, we had a really tough time in the early days, but now then we went through the dark days, and now everything's great. We've made it. Like, that's not like, look,
shit. We're gonna get on a call after this to solve another problem that we're having.
Well, it feels like there's more work to do now than there was years ago, right? Like, if you ever climbed a mountain, like when you look at a mountain from far away, you're like, oh, that doesn't look so bad. And then you get closer and it's like, oh, that's actually quite steep. And then you get halfway up and it's like, oh, it's actually pretty crazy. And so we're sort of at that pace where we're like, oh, wow, there's a lot to do. So 5,000 businesses, there's 25 million e-commerce businesses out there that probably need our help and growing every day. And so now we're starting to think about how do we if we're going to achieve our mission in our lifetime of really empowering entrepreneurship and unlocking sort of this opportunity and this entrepreneurial opportunity in every corner of the world, we're going to have to start doing things very differently, right? And we're going to have to start really doing this at a different scale. And so there's new challenges, and we're still facing them on a daily basis.
Actually, what are your respective titles?
CEO and president.
Okay. And how do you guys split responsibilities?
I'm kind of I've come up with the crazy ideas. That's basically I'm kind of product development, sort of new idea generation. Michele makes sure that we don't die.
And we hit our number, and we hit crazy growth targets, and
we can grow, and I don't blow up the company in the process of trying to invent the future.
Yeah, I mean, we've kind of figured out a magical relationship between us over the years, and we've actually taken different roles at different places in the company. Actually, I actually remember in the early days, Andrew, you were probably a little bit more scared of innovation and some of the things we were trying, and now I'm more scared. And so we've switched that role over time. But I mean, Andrew is an incredible visionary, and it's just we've figured out and we don't have an ego about it, right? When something's not working in the company, it's like, hey, can you take on this group or this project or this initiative? And I think that's been probably one of the secrets of us making it this far.
And it happened organically, or do you actually sit down and talk about, okay, this is working, this is not working, I should do this, or you should do that, or?
Oh, are you kidding me? No one can read your mind. None of this is organic. You have to be very good. And I mean, we try and, talking about this in our company that, there's this idea that you lead with love, you lead that you care for a person, but when you care, you give them really honest and open feedback. And there's been periods that I don't think, we've done that, and we've actually seen that deteriorate the relationship. But I mean, for example, we take the first week of January to just talk about what went right, why didn't things go right, where could we have used my skill set versus your skill set, where these wins came from when these losses. It's actually a very deliberate, and all we do for an entire week.
And that's just the two of you, or that's the greater management team?
That's actually just the two of us. We did that this year, and I think that was so important. I don't know, Andrew, if you want to add to that, but that's my perspective, that these are things that are constantly work in progress.
Yeah, I think Michele and I have very different experiences and skill sets, and I think that if in the moments where we haven't been able to identify that, it's led to friction. But in the moments where we've been able to lean into it, I think it's led to like much more success. And so, I think we would have struggled to build a company at this pace, at this scale, without those complementary skills. And I think what we're starting to do now is land into a really good rhythm of where where we hand things off to each other and trade those things off for sure.
But Fabrice, the one line joke could be like, this company would have been a hundredth of its size if I was running it alone, and this company would have gone bankrupt 50 times if Andrew was running. So we protect each other, which is important.
That's definitely been true with my co-founders in the past, because I was more in the Andrew role of like, go for broke, put it all out there, come up with ideas, and like in 08, 09, in the financial crisis, I'm like, this is the biggest opportunity we've ever had. Let's accelerate. Everyone is like, no, hold back. So what were the biggest challenges along the way? Was it like raising debt in order to have capital to lend to startups? Was it like figuring out the algorithm? Was it like I mean, I'm sure there are a lot of challenges along the way, but it'd be interesting to hear like what are the biggest things or things that could have been pivotal in like not getting you to where you are today.
Yeah, on the debt side, I mean, the debt was sort of like painful, and then all at once, right? It's kind of one of these things where you're trying to create a new asset class. You're trying to prove to the world that you know how to do something and you can create, a return on something that hasn't existed before. And so everybody's quite skeptical until it works. And then as soon as it works, the floodgates open and everybody wants to give you capital. And so that was certainly a challenge in the early days. It's less so now. I think the biggest challenge, now and going forward has been hiring and culture, especially in kind of a remote and distributed world. We hire a lot of founders. We hire a lot of people who have built their own businesses, come from entrepreneurial families, have ambitions of starting their own companies in the future, have side hustles. And that's amazing because it leads to a lot of innovation, a lot of, like no bureaucracy. People just, get you done. But it's hard to organize 300 founders, especially when you're not in the same room. And so there's a lot of passion. A lot of people really believe in the mission, and so getting everybody on the same page, trying to give everybody the same context. We're learning to be sort of Zoom leaders in real time, and it didn't come naturally to either Michele or I, but we see the advantages of being able to hire people anywhere in the world and allowing those people to work from anywhere that they want to, and so. It's definitely an advantage, but we can't wait until we can actually get our whole team together, at least for a retreat, and kind of reset the culture. Michele, anything else that on biggest challenges on the journey?
Sometimes I'm like, where do we even start? But no, I think one of the things I think a lot about is that as a leader, what got us here won't necessarily get us up that next part of the mountain. And I think that's the scariest part, because there is so much of this job that is trusting your gut. Like, there were so many decisions I made along the way, and Andrew and I made along the way, where I'm like, this doesn't feel right. Like, this doesn't feel, people are not working hard enough. This isn't working, or like we're going to lose this deal for this reason. And, what you need at an early stage, and the aggressiveness you need, and that's very different than what you need as you grow and scale up. And so I think that's the other thing that Andrew and I keep in mind as leaders, is that how do we mature ourselves? I mean, a global company with 300 people looks very different than when Andrew and I could be like, wait a second, you're not closing this deal? Put me on the phone with the founder in 5 minutes and I'll do it for you. You know what I mean? Like, it's like we did that, and we have all of that. And trust me, my gut instinct when something isn't working is to still stick my hand in it and try and fix it. But that is not completely scalable. And so I think that as like a global challenge is like totally different, because it means we actually have to change as humans as things grow. And so I would be lying if I said that wasn't scary, but I'm up for the challenge, and I know Andrew is too.
On that note, you should probably read Safi Bakal's book Loonshots, because it talks about once an organization is large, the way
Yeah.
you create these franchise businesses, which are the ones that are delivering on a regular basis, and they're going to be
Yeah.
paying the bills, and then you create the
Yeah.
loonshot business, which is the one like breaking the mold, trying to keep innovating. This way you
Yeah.
can try to have a balance, because the franchise businesses are not good at innovating because they need to like have processes and keep fixing things, but the guys who keep breaking things are not good at like running the franchises and make sure they don't blow up.
Yeah, no, and
Yeah.
I mean that's literally how Andrew and I have now divided the company. And I've met Safi at Curiosity Camp. He was amazing. It's so many good
Yeah,
stories
extraordinary
of
storyteller, and yeah.
he's awesome.
What are and okay, so we talked a little bit about challenges. What about like lessons learned? I mean, what would be the one or two the biggest lessons learned along the way, if any?
I think it comes down like it's probably these conviction moments, right? And I think like this is why people back founders. This is why this is why investors like founders. This is why we have our jobs. Is because like you have to bet hard when you have conviction. And I would say we've done that at moments in time.
Yeah.
I would have bet harder, at those moments faster. I think that's probably the biggest thing. We did a few different pivots. We funded different types of businesses before we sort of landed on e-commerce, and we probably could have even a quarter or two gone harder at the e-commerce world. I think about the pandemic last year. We had laid the foundations for our international expansion. We were looking. The last trip I took was to Dublin and Amsterdam to look for a European office, European headquarters, before things shut down. And in this world, sort of, we had reduced complexity. We slowed down our international expansion plans, and have only just sort of restarted them. Later 2020, early 2021, when in reality, with the acceleration of e-commerce in the past year, we probably could have been more aggressive on our international expansion, through 2020. So I think those moments where you really have conviction as a founder, sometimes you look for data to back up your conviction for too long, and you miss opportunity. And I would say, we've certainly learned that, but betting harder when you have conviction is probably one of the big areas. I don't know, Michelle.
Yeah, I mean, I can probably even give you like some color to this story. I mean, when we say Andrew and I had conviction, it was like there wasn't enough data, and there were moments where our board actually said like, no, you guys shouldn't do this. Like this was not just like we didn't want to bet on ourselves. There was a whole other external group of people who, to be clear, are extremely important to us because they are backed us that were saying, well, why don't you guys wait another couple quarters? And we made this very hard pivot from a business that was majority focused on Airbnb to one that was majority focused in e-commerce. And Andrew and I did the math on, well, if we miss this Black Friday, we're going to miss a whole year. But that's one of the lessons I learned, is that you cannot look for unanimous support in your board or your company or society ever, and you will not have the data. I mean, one of my favorite lines is like, as soon as McKinsey's published something, like there are already $6 billion companies doing it, right? Like you will not have that data to be like, the market size is this big and you're going to be able to do this. It's going to actually feel exactly as Andrew described, way more like a founder intuition type of thing. Like I'm just seeing early signs that I typically don't see with other products. And so I wish I had, I mean, like, it's been a career of doing this, but like every time it surprises me on how little support there is for when you're making some of these big decisions and bets. And then I think the other thing is being, absolutely relentless around problem solving. And sometimes as a founder, you just feel so exhausted. You know what I mean? Something will be broken in your
Yeah.
go-to-market cycle, and you'll just be like, well, we tried 1, 2, 3. I mean, we finally fixed one of the big challenges in our sales process. And I think we were at iteration 8 or 9 or 10. Like it truly took that many. And I mean, you have to imagine what your team feels like when you're changing something for the 8th time. Like they want to throw tomatoes at you. They're like, you guys don't know what you're doing, which, to be clear, is absolutely correct. You don't know what you're doing. You are trying all the things. You are building something from scratch. And instilling that incredible transparency. And I mean, Andrew is so good at this. He's so like just and has constantly encouraged me to be better at this. Like, we're going to give people all the information and all the facts, and we are not going to sit here and pretend that we know. And we're going to say, we need you to take swing number 8 with us. And ultimately, at some point, that becomes a much harder conversation, because it's like, I appreciate we're at swing number 8, and if you don't want to do this with us, you can leave. And if you want to keep doing this, we need your full attention and energy to see if this is our problem to solve. And I think that most people give up at try number 3. And I think that many of our big breakthroughs as a company have probably occurred around like the 8 or 9 mark, which actually means it's like, oh, it's so nice to hear you like didn't give up and like all the platitudes. No. It actually means that you had to take all the people along the way as your own core team started doubting you, which is like the harder part to get right.
That's interesting. Like, that's the definition of grit, because in a way, it's not your own grit that's the issue. It's the grit of the team around you, and you need to get them there to keep throwing spaghetti on the wall when all the other spaghetti has fallen off.
Well, there's only so much. There's only so much force of personality, right? People are like, look, I'll follow a leader that I believe in, but at the end of the day, they're kind of like, do you even know what you're doing? Right? So at some point, you've got to be like, no, right? Like, all I know is that like this future should exist. I think we're well positioned to go create it, but we're gonna have to figure it out together, right? And so I think that's one of the things, that the more transparent you can be with your team, and instead of them following you for like, I think a lot of times people follow founders in blind faith, and that only gets you so far. So the sooner you can be like, no, like, you're actually part of the solution. We're going to need you to come up with this with us. The sooner you can get that, the more bought in people are in sort of getting you to that 8, 9, 10 iteration.
Yeah, because, and then again, it's when you're 10 people in a room, it's easy. But when you want to innovate at a company this size, and we just want to solve some of these problems, like things break or they don't scale. But that, I think, was a pretty big lesson learned for me as we went through this kind of, call it $100 million to $2 billion scaling phase.
I think that I mean, Paul Graham, one of his core lessons is not only do things that don't scale, but actually do things that don't scale for longer than you think you should be doing them, until you really figure it out. And once you've nailed it, then you automate it, you scale it, you process it. But until then, it's wasting, frankly, dev cycles to try to be automating things that are not meant to be scaled yet.
Yeah.
So switching gears, how big is the Shark Tank of Canada? Like how useful was that for Clearco in the early days? And also, has that changed your life? Like, are you now a celebrity? You walk in the street and people are asking for your autograph? Do you need security or something like that?
I don't know. You can answer that better than I can.
Michele, I mean, Canada's a little bit better than the US, I think, because even though people recognize Michele, they don't always ask for an autograph. And if we really don't want to be bothered, I'm like, oh yeah, she gets that all the time. She looks just like her. It's sort of like, but no, for the most part, people are really good. But I think it's. I mean, you can talk a little bit more about it, Michele. What's the impact on your life? But I think for the company, it's been great from a recruiting standpoint. Everybody knows about the company, and everybody knows about Michele, and that's been super helpful. And a lot of founders sort of builds a lot of trust, at least in the Canadian market, for sure. Yeah,
I think it's definitely been a unique experience. I think I'm most grateful for it because it gave me my first opportunity to move from a founder into an investor. And I think it was actually coming in, and this is one of my core theses on everything, is like the worst people to innovate often, not always, but are the people that have been in that industry, because they just say, well, it's always been done this way. You know what
Absolutely.
I mean? You use this agent and this thing, and it was like coming in. And I think it was because like, I joined the show when I was 28. I just sold this company to Groupon, but I mean, like, I was 30 years younger than everyone else on the panel. Like, I definitely felt like the runt of the litter. I felt the poorest. And that gave me just a unique way to look at these companies and what they were saying. So I'm incredibly grateful for that and for the platform. I think, both Andrew and I just like think if we have one mission in this world, it's like, how do we get more founders to win? Because they are the ones that build the world that we want to live in, right? You think about government, spend trillions of dollars on climate change. It was like the entrepreneurs that built the cars, trucks people wanted to drive, and the Nest thermostat, those made a meaningful difference. And, our view generally is that most of those people have been overlooked by the system, because not only did you have to be a great entrepreneur with great ideas and great traction, but you needed to know the people that could fund your business. And so that was not hard if you went to Harvard and Stanford, because 40% of VCs went to Harvard or Stanford. But it was harder when you were not a part of that circle. And I mean, it's not like a new thing. Like if you knew the king 2,000 years ago, your project's got funded. But we just imagine a world where, if you have great traction, your idea can get funded. I think the other thing that I would say about the show is it was a great base of early customers, but Canada's 2% of the global economy. We weren't going to build a business that was this big just sticking to Canada. And so one of, I think, the really important critical decisions Andrew and I made in the early days is starting this out of the US, is starting this focused on the US market. I think the reason when we figured out that we could be successful with San Francisco-based companies that were in the largest venture capital ecosystem in the world, that gave us the confidence to say, well, this will work everywhere.
So the $2 billion of financing you provided to date, like what percentage is in the US?
Oh, the vast majority.
I mean, by the way, $2 billion is huge, right? Like, I don't know what the size of venture capital is these days, but for a long time it was like 50 billion, right? Like per year. So it isn't. It's not venture capital is like gets a lot of attention and press, but when you think about the amount of capital actually deployed, it's relative to whatever the $10 trillion stock market and the tens of trillions of dollars in bonds. It's actually not that much capital allocation. Probably the most leverage. I mean, and I think a lot of what you say is also the mission driven really connects with me, because the reason I'm an entrepreneur and I'm an investor is I want to invest in the world and that I want to see in the future. And I think politics is so fundamentally broken. They're not actually solving the world's problems. And if I think of the biggest problems that we're facing right now, both in the inequality of opportunity side and social injustice on the one hand and climate change, technology is going to fix it. And and harnessing the deflationary power of technology and harnessing its ability to improve user experiences is the solution. And also another thing that's interesting that draws corollary, and I hadn't thought about it, because I think of you guys as entrepreneurs. But because you're entrepreneurs, you're founding and you're building a company, but you're actually investors, right? Like you're investing in these 5,000 stores of different sizes. So you're both entrepreneurs and founders and investors, which of course I see myself in the same light, as I'm investing in all these founders, and I'm also building companies on a regular basis to try to build the future that I want to live in. So it's interesting. Like it hadn't crossed my mind that you saw yourself as an investor as well, but actually, absolutely, you are that.
Yeah, I think.
Go ahead.
Yeah. We are sort of, I think the way we think about investing though is we're sort of rethinking that in a way that is, investing for generations has been a human driven business, and humans only have so many hours in a day, and and so part of what happens is humans introduce a bias, right? You need a filter. You can only take so many meetings, you can only sit on so many boards, you can only make so many investments. And so you're like, okay, well, how do I know which meetings I should take? And it's, do I get a warm introduction from somebody that I trust? Who are the people that I trust? It's the people that I've worked with before. It's people that I went to school with before. It's people that live in my same social circle. And so inherently, what happens is your deal flow gets filtered through this, bias filter, not for any nefarious reasons, just because of the way that, humans in society and social networks evolve. And the two challenges there are, for the most part, you don't start to see, like, so we've, some of the businesses we're most proud of backing are people that have built products for, autistic children, or, diabetics, or people with like certain skin conditions and hair conditions and, breathing conditions and things that, the typical investor probably never faces or doesn't know anybody that faces in their day-to-day life. But so those founders maybe never get the opportunity to even pitch an investor on their business. And when they do, because it's a human-driven business, that investor can't relate to the problem. And so when you remove that bias, and you look, it doesn't matter if you have a product that solves a problem in the world, and you know how to find your customers, and you know how to build a business that is right side up, we can continue to fund you. We don't care whether we would buy your product. We don't care if we even understand the problem. If you understand the problem and your customers understand the problem, and you know how to find those customers, then obviously that product should exist in the world.
So I love that, the democratization of finance, because if you think about it, we've had democratization of startup creation, right? Like in the mid-90s, you had to be in Silicon Valley in order to have the skill set, the capital, and everything to go and build and build new companies. And then you started getting, I mean, you needed like millions of dollars. You needed to build your data center. You needed Oracle database licenses. You needed Microsoft web servers. And then the early 2000s, you started getting the open source movement, so it became cheaper to build startups. Then you got like Amazon Web Services, and you started getting a lot of the open source cloud-based solutions. So it became cheaper to build companies. But actually, even though you can build companies all around the world, and we're seeing and no code actually continues that. Right now, you don't even need technical skills to go and build software, and Shopify falls in that category. But actually, venture capital remained very concentrated in the major cities. So yes, it democratized away from Silicon Valley to like New York and like London and Paris and Berlin, etc. But if you weren't in these cities, you weren't getting funded. And so actually finding out, so we've had democratization of company creation. So the next step actually makes sense when you think about it now is like democratization of financing. So these companies can scale from everywhere and not just, New York and San Francisco and Austin or whatever.
Yeah, I don't know if you ever read Naval talked a little bit about permission and permissionless leverage, right? And so you talk about like knowledge as, permissionless. You talk about human capital, labor as permission leverage. For most of history, financial capital has been permission leverage. You have to convince somebody to give you the capital. What we're trying to do is make that permissionless, right? You build a product that is worthwhile, and the financial capital just comes.
Yeah, that makes a lot of sense. Um, switching gears or changing topic, were you guys dating like before you started the company, or did that come along and like the way? Because it has to be super challenging, right? Like most VCs probably were like, oh my god, like I don't want to. If they break up, it's the end of the company. Like, how does that happen, or how did that?
Yeah.
I mean, if you're comfortable talking about it, I'm happy to not talk about
it. Well, I messaged Andrew for fundraising help. Andrew, why don't you tell a little bit of the story?
Oh man, yeah. So I didn't know actually if that first meeting was a date or not. I ended up, I got there early. It was a Mexican restaurant we were meeting at. I ordered a pitcher of margaritas. Michele drove, so it was obviously a business meeting. So I drank the pitcher of margaritas myself and introduced her to a bunch of investors. No, but you know what? So we kind of kept in touch over the course of a year. We ended up dating about a year after we first met.
But before creating the company or after creating the company?
No, before.
Okay, well before. Okay.
Yeah, before creating the company, I was running another tech company, helping them fundraise. That's actually an interesting story. I joined this company. They had like 6 weeks of runway left. They put most of the money into inventory. They were trying to spend money on marketing and inventory. We needed to go raise capital. We did this sort of shotgun wedding approach of get the best terms we could or get the best deal we could. Brought on an investor that was a little bit misaligned, and one or two they wanted to take the company in a different direction. So as soon as we missed a number, they had control of the board. They basically brought in their own management team, wiped us all, and sort of said, we're taking this company over. And I think they've sort of run it, plateaued the business from there. But Michele and I had just been dating. So she had just sold her company. We had just started dating for a few months. I came home and I was like, hey, I think I'm out of a job. What should I do? And she's like, oh, this is great. We'll start a company. And that was it. And then I was pretty,
because that's actually a huge step, right? Or like it puts so much pressure even on the relationship. Like we're starting a company together that is a 93% 5-year death rate on average as a company, and we're dating. I mean, that did you actually think about it, or like, yeah, how did that go?
Actually think about it.
but like it sounds like a brilliant idea, but then you're like, whoa, like.
Yeah, it was. I don't know, Michele. What did you think about it? I thought I was terrified. So I don't know.
Fabrice, you're right. Like for sure, I certainly didn't think that this would have a 93% failure rate. Never did I give myself that stat. I think it's actually the same thing with gender stats. You know what I mean? If I thought about the fact that I'd be a less effective fundraiser because I was a woman, you'd never be successful.
All right, look, by the way, I think that's the stat, but it doesn't mean that you believe it, right? Like obviously, every founder I back and I know is like, oh, obviously, I can change reality. I have this reality distortion field. These stats don't apply to me. My success rate is at least 50%.
Totally. I think here's the other thing I'd say about a relationship is you need to work with somebody. I think that there are sole founders, but even the sole founders that we talk about and celebrate in the media had very, very strong number twos and number threes that were incredibly um, close with them. And so then it's really about finding the best person that you can work with. And Andrew, without a question, was just the best person that I could work with. I
Makes
mean, he
sense.
was an incredible founder. We had similar, we had the same values, but we actually had different skill sets. We had different ways of solving problems. One of the things that I think is unique in our relationship is like, okay, so Andrew and I will fight about a lot of things, and so he'll start at position A, and I'll start at position B. We actually almost never end at position A or B. We land at a hybrid, which is C. And sorry, I shouldn't do it like this because we actually don't cut the middle. It's not like we compromise and both give up.
Yeah.
It's actually we found a third option that neither of us thought about that was completely different from A and B. And that I think is the hallmark of an incredible team. Like if I was to nail it down
That
to
makes
everything,
sense. Yeah.
trust me, we are very passionate when we start out with A and B. It's like we can't do this, we
Yeah.
have to do this, and it's like we end up working through these problems enough that it's like, oh man, this is so much better than what we started with. And it's not a nice process. It's a process that involves lots of emotions at times and lots of like frustration, but that's what's built, I think, these points. And so, if it's like, look, I get that people perceive there to be more risk if you're somehow dating or if you're together. I think that when co-founders fall apart, companies fall apart. And
Yeah.
the probability of that happening, I'm not sure is that much different if you're in a relationship versus you're not.
Yeah, no, I agree. And by
I
the way, like some of the best founders we've seen are actually married or couples because
Yeah.
they can finish each other's sentences. They understand each other. There's respect. There's trust. Even when they disagree, they're like, it's okay. I see where you're coming from, and they're willing to try. And so it actually could work really, really well. But it's just interesting because clearly there's usually an innate response of like, oh my God, that's a terrible idea, right?
Oh, man.
Yeah.
Andrew, you tell us. There was lots of investors that said no in the C, no in the A, no in the B, and then they finally like, okay, we have to be in this company. I was like, guys, you've known
Yeah.
both of us. And they even had the balls to be like, if you guys would have started this company, either of you alone, we would have backed either of you. So
Yeah.
anyway, Fabrice, you should feel proud. You didn't let this get in
How
the way
did
of
we
your
get? How
investment.
did we meet? Like, do you remember when? I don't even remember when we invested.
It was a Canadian lawyer. It was
Oh,
Chad that
Chad! Oh my
introduced us.
God, he's like
Yeah.
that.
Yeah.
He's really is the godfather of like the Canadian tech ecosystem. He's probably introduced me to most of the deals
Yeah.
I've done in Canada.
Yeah,
No,
and you were like, I mean, you were our version of what we want as a perfect like you were fast and you were like, "Okay, I got this." Like there was no drama. Anyway, it's been amazing. Sorry, Andrea, I interrupted you there.
no, yeah, I think that was just it. It was like, we had investors who would have backed either of us, had backed us in previous companies, but were like, we can't back you guys as a couple, and they said no several times, and then they invested at basically 100x the valuation finally, because they were like, well, we need to put the logo on our website. So I was like, all right, well,
Okay, so you just raised like $250 million at 2 billion or something like that, post money valuation, if I'm not mistaken. I mean, whatever the numbers are public, I don't know what's public. You can give the
yeah,
summary.
we raised billion equity and then another 250 of like off balance sheet capital. So we've been trying to be, we're trying to be really efficient on the equity, and then obviously we tell our founders to minimize dilution. So we try to be really efficient on the equity. Similarly, the way we raise capital is we've got a capital markets fixed income side and an equity side. And so yeah, just under $2 billion valuation.
And so what's next?
So a couple big things, right? I think one, we had mentioned a little bit about really investing in helping these founders go beyond just capital, right? So using the data to help them make better decisions, introduce them to a network, really like all the benefits, all the good parts that you get from a VC, which is like opening doors, helping you see around corners, pattern recognition. We want to try and turbocharge that with technology. And then we want to do it globally. And so we're really investing in our international expansion. We think that exactly the next Elon Musk could come from sub-Saharan Africa or Southeast Asia, and we want to find them, and we want to be able to identify that talent and unlock capital for that talent wherever they exist.
And why rename from Clearbanc to Clearco? Clearbanc seems to be a great name for like a future of finance,
I think I think when you say the word Clearbanc, everyone just thought capital. And last year,
Everyone's just
we
thought what?
launched
Sorry, it cut off a little bit.
of capital.
Capital. Okay.
That's okay. They just capital. They just thought of money, and that banks had just always been associated with that's where I get to capital.
Mm.
And so, as we thought about expanding, I mean, we launched 4 new products this year, and many of them were non-capital products on how we give founders that competitive edge on network and advice. And so, kind of moving beyond capital was the rebrand story from Clearbanc into Clearco, and I love it.
Okay. Clear.com was not available. Like, we're clear. I don't know. So anything we didn't cover that we should have covered, or any stories you want to share, anything else, any news you want to announce, or
Yeah, I'd say the couple things especially for listeners, one, we're hiring. So if you're looking at joining a company, if you're looking at being a founder and you want to join a company that'll accelerate, I mean, we've had probably in our short history 10 or 12 venture-backed companies that have started from employees that have left. We've invested in, I think, all of them.
Yeah.
Building a program to do that programmatically for people that have been here for a couple of years and start their own company. So this is a great place for future founders to start their career or accelerate their career. And then, we're really starting to expand the value proposition. So from very, very early stage, idea stage, super early revenue businesses, all the way up to companies. Our largest companies will do hundreds of millions of dollars. We've got a couple companies that will go public, and we can support you sort of, that entire journey. And so we'd love to talk to people on that front.
Perfect. Well, thank you, and thank you for joining the show. This was super fun, and I look forward to having you on the show in a few years and hearing how the rest of the journey went. As at that point, we'll have backed, hopefully 1 million businesses. We'll have like really made a dent and like democratizing finance writ large at a global level. It'll be super fun.
Yeah. No. Well, thank you so much for your support along the way. It's been really, really.
Yeah, it has been great to work with you guys. So thank you, and to all the audience, I'll see you next week. We're talking about the end of jobs and the future of work. Thank you, everyone.